Hi, and welcome back again to Option Optics. We'll be taking a look at the IV reversion, the closeout potential in a week's time frame on our vol capture trades in the metals company TMC, where the stock went against us somewhat from a delta perspective, but because of the huge vol capture, able to capture some very nice profits. So let's jump in and take a look. Here it is from a week ago, and we did post that video on the YouTube channel as well, so you can certainly take a look at that. But we saw this huge spike in IV on the metals companies. You can see here a quick recap, right? So this sets up a plethora, four different sort of trade scenarios that we're able to take advantage of. Here is that reversion, right, as the IV finally starting to revert as it normally does. Here you can see on Friday's close, IV reverting further. Here's the day we put the trade on with that spike in IV. Didn't hit the absolute top, as you can see here, right? IV did actually squeak a little bit higher. We'll take a look in a second, but it did come down. We were able to capture some nice profits in a fairly neutral fashion. So you can see IV in Dece and Jan both dropping from Thursday to Friday and dropping overall. You can see the IV percentile now at 70%. Back then, the IV percentile at 82. Call and put volume both starting to ebb, which leads to that IV reversion, right? 72,000 calls on the day we put the trade on. On the day we took the trade off, only 15,000. Same with the puts, much lower volume. Here you can see, here's the time frame when we put the trade on, and it did spike a little bit higher, as we alluded to, but here's that big drop, which sets up for some very nice vol capture trades. So here's that January 7th straddle, one of the trades, right? We put the trade on December 6th, right? As we saw that huge spike in IV, able to sell that Jan 7 straddle for 250. Then on Friday's close, right, that Jan 50 straddle had fallen back down in price, as you can see, able to settle, excuse me, at 285 with the stock at 696, right? IV at 141. On Friday, the stock actually closed at 759, got further away from the 7 straddle, should be a negative, but because IV dropped to 126, right, from the previous day at 141, we were able to capture some very nice profits here of about 35 cents. We can take a look at the metrics on that one, right? So here's the original date, our November 6th kind of benchmark point, right, with IV at 104. Here's the day we put the trade on, November 28th. IV got to that 141 level, right? That huge spike in IV that we saw here, that's what was the impetus for the trade. And then on Friday, you can see IV drop from 141 to 126, almost a 15 vol point drop. The deltas actually went against us a little bit, right? We were 19 deltas short, got to 32 deltas short, and with the stock going up 63 cents, you'd expect a 16-cent loss from the deltas, right? About a 10-cent time decay gain, right? Generally give or take a penny here or there. So our expected loss on the trade, everything being equal, besides delta and theta, expect to lose about 6 cents, but we actually gained 35 cents. Why? That huge drop in IV of almost 15 vol points. So our vol capture trade of almost 40 cents, even with the stock going against us. We can take a look at the Jan 8-6 strangle, right? The stock, as we said on the day of the trade at 696, that Jan 8-6 strangle, trading at 212 IV of 151. Then on Friday's close, when we said, hey, let's take this thing up, stock closed 759, as we said, that Jan 6-8 strangle actually dropped in price from 212, right, over $2 to $1.55. So a very nice gain. Deltas went against us, right? We were short 22 deltas. The stock went up, and the delta perspective is now 33. But because of that big drop in IV from 151 to 121, we were able to capture some very nice gains. Same thing with the 9-7 strangle, right? A little more or less bearish, I should say, pretty neutral, right? Because the 7 put in the money slightly at trade inception. We were able to sell that 7-9 strangle for 235, about 146 IV. Then on Friday, with the delta starting to go against us, right, -2, -9, right, we were able to actually book a very nice profit from 235 to 177 and a half. Why? Because IV dropped to 127 from almost 147. Taking a look at the metrics there, here you can see the Jan 6/8 strangle, right? IV at the time of the trade 151, IV dropped to 121, right? The strangle actually proved to be a 57 and a half gain, right? We sold it at 212, bought it at 155, even with the deltas going against us. So our expected delta loss would have been about 17 cents, about a 10 cents time decay or theta gain. So our expected loss would have been about 7 cents from a delta theta combined perspective, but because our IV dropped, the Vega effect, if you will, right, we're able to capture a very nice gain, right, of 57 and a half cents, or our vol capture 57 and a half cents plus the 7 cents we would have lost, about a 65-cent gain just on that vol capture. 7/9 strangle, same scenario there too. IV at 146, dropping to 127, a 19 almost point vol drop here, right? Deltas again went against us, a little stock up. We are delta short slightly, got a little more delta short as the stock moved against us. So we'd expect about a 3-cent delta loss, 10-cent theta time decay gain. So expect to make a little bit, about 7 cents. We made 57 and a half cents, so made 50 cents on this trade. So another very nice vol capture feature, again, able, if you will, to sell that spike, wait for that reversion back down, right? As we can see here too, able to sell it at 133, dropping generally to 127, going out to May. The May 10 straddle again, day of the trade. Stock at 696, $7 almost. That May 10 straddle at 640. IV about 140. Then fast forward to Friday. Stock moved advantageously, right? But note that the deltas didn't move too much at all, simply because we had that drop in IV, right? So now the IV dropping to 122, we were able to capture a very nice gain of 65 cents on this trade, right? Very neutral trade, most of it being vol capture. We can also take a look at that May 9 straddle as well. Same sort of idea here. Sold it at 696 at a 130 IV. The price we sold the straddle for, 555, right? Fast forward to Friday's close. Stock rallied, right? Which is actually advantageous for this trade, right? As we talked about in the previous video. That May 9 straddle dropped to 530 from 555, a nice 25-cent net gain because IV plummeted here as well. So we can also take a look at the metrics on that. That May 10 straddle, stock at 696 went to 759. Most importantly, IV selling about a 140, buying a 123, so able to capture about 60 cents simply because of that vol drop, right? Same thing with that May 9 straddle, able to capture about 25 cents because of that vol drop. And then finally that Feb 610 strangle, right? Put it on back a week ago, right? With the stock at 696 for about $2.15, slightly delta short, 13 deltas net short. More importantly, sold that IV at 135. Friday's close, when we said let's cover it, stock moved advantageously from a price perspective. We got a little more delta short, right, from 13 to 19, simply because anytime you get high IV generally, right, the upward drift tends to float the deltas on these lower price stocks on the call side higher. We can see that the IV plummeted to 117 from 135, so able to capture a very nice gain indeed. We'll take a look at that. Here you can see we put the trade on with the stock at 696 a week ago. That 610 strangle trading at about $2.20 or so, about 13 deltas net short, selling about just under a 140 IV. Fast forward to Friday when we said, hey, let's close this out. Stock rallied. That strangle, right, able to pick up 50 cents on it, all on a fairly neutral trade in a week's time frame, right? Delta did go up a little bit because the stock went up the call delta went up, the IV plummeted 20 vol points, a huge move for out in February. So basically, we expect from a delta perspective, lose a dime, pick up about a dime time decay, so everything being equal, even. But we are able to capture 50 cents simply because the vol moved from 138 to 118 roughly. So that's the advantage again of going out and taking advantage of that huge spike in implied volatility and then the drop lower right, looking for that reversion effect. So we're always looking to sell the pop, buy the drop, cover it back down, not looking for it to maybe head back here. Right there, it gets sticky here as far as the reversion, but more than happy to take the trade off for some very nice gains in just a week time frame. So hopefully explains how we go about identifying and positioning trade opportunities here at Option Optics. Until next time, as always, here's the good trading. Take care.